What is up, investors? Sam Hack here with Rent to Retirement. I'm here today to talk to you about, you guessed it, real estate investing. If you don't know us already, Rent to Retirement is your partner for real estate education, strategy, and bridging the gap to investing in cash flowing rental real estate investments. Today, I'm going to be diving into the basics of real estate investing terms and metrics that are the building blocks for evaluating rental properties. This is the ABCs and 1, 2, 3s of real estate investing. Enjoy the video. We don't want to invest in just anything. We want the numbers to do the talking instead of letting our egos and emotions make the deals for us. That never ends well. Chefs don't just cook food without checking the expiration date or serve that food at any temperature, do they? To serve up a masterful portfolio of investment properties, we need the right tools for the job. Don't forget to like, subscribe, and turn on the notification bell below to stay current with our videos. Oh, and if you haven't already, please go back and check out my 5 benefits of real estate investing video. It will explain why we're doing all this crazy investing stuff in the first place. After you complete this video, please go back and watch it again or discuss it a second time with a friend, family member, or business connection so your retention will increase and these terms and metrics will really be committed to memory for you. Let's start this off very simple with total cash needed. This is how much money you will need right now to make the purchase of an investment property. We usually factor in about 20 to 25% of the purchase price of the property as the down payment, plus about $3,000 in closing costs, which include about $1,000 for loan origination, $1,000 for title fees, and about $500 each for appraisal and inspection. All right, easing into it. Term number 2 here, this is principal reduction. Principal reduction is referring to paying down the amount of principal you owe on your mortgage with each payment made, and can be best visualized on an amortization table. At the same time that we're paying back the amount of principal that we owe to the lender, that also means we're building up our equity in the property. That being said, how do we figure out our principal reduction? Well, we're gonna use this formula, okay? Principal reduction equals our original loan amount minus the loan balance, the amount of the loan that we still have to pay. Our other part of building equity, besides principal reduction, is appreciation. Term number 3, appreciation. So appreciation is how much the value of your home increases over time. Now, we never really know what the true value of any asset is until someone buys that asset from you at that price. But what we can do is get an approximation on a property's value based on comparables or comps. Appreciation is also a speculatory metric, just like buying a stock, because you can't foresee the future. Appreciation is dependent on a bunch of things, including both the national and local housing markets. For instance, housing prices may be going up everywhere in America because of macroeconomic changes, or a new luxury development breaks ground near your house, raising prices nearby. On average, we can expect appreciation to match or beat inflation, usually somewhere between 2 to 4% on average, but we've seen as much as 6 to 9% in some of our markets over the last few years. Appreciation can change with time. You can see massive appreciation in just a few years, like in Austin, Texas is seeing right now, with the movement of Tesla and other major companies moving there. These big company moves create more housing demand as new workers move there, driving prices up and increasing the appreciation rate. Next, let's quickly touch on forced appreciation. Forced appreciation is adding something or fixing something up on a property. You have to be strategic about this because you want the amount of money you put into a project to give you a good multiple compared to what you'll get out. This is the essence of what house flippers do. They'll put in $5,000 for new paint and stainless steel appliances and actually get $20,000 of value out in the sale, keeping the difference. In our case, as investors, we would continue to hold the property and simply rent it out for more because it is now a more desirable property to rent. Term number 4, net operating income. This might seem like an intimidating term for us to go over now, but I promise you it's not. Let's break it down. So first, net just means after something else is subtracted out. Operating just means coming from a business activity, and income means money coming into our pocket. So our formula for net operating income is, drum roll please, net operating income, or NOI, is equal to gross income minus expenses. That's it. Not so scary after all. Put another way, NOI is our rental income after operating expenses are taken out on a yearly basis. Our rental income is what the tenants pay us in rent, and our operating expenses are things such as insurance, repairs, etc. Anything that costs us money in the ownership of a rental property, with the exception of the mortgage payment, aka debt service. The reason we don't factor in debt service right away is because debt service is discretionary. Rental property owners choose to leverage their money at different levels depending on their own personal financial situation. If we didn't have any mortgage, or aka leverage, our NOI would be equal to your cash flow amount if you paid all cash for a property. If we bought a property in cash and had no mortgage or leverage, our NOI would be equal to our cash flow amount. Now on to cash flow. Term number 5, cash flow. This is by far the best metric in all of real estate investing, and it just sounds so good. Phrases that are often synonymous with cash flow are mailbox money and passive income. This is what usually gets people interested in rental real estate in the first place, making money in your sleep. Cash flow is the key to retiring or replacing your active income received from your job. Cash flow from rent shows up every month, whether you work or not. So what is cash flow? No, cash flow is not buying low and selling high for cash. We are not house flipping or timing the market in any way. What cash flow is the monthly income received from rent and all other income sources after all expenses and mortgage payments are taken out. Cash flow is just like our NOI, except now our debt service is taken out of the number and counted as an expense. Cash flow is a true definition of total income minus total expenses. Term number 6, cash on cash return. Our cash on cash return is how much of our money we get back each year. As long as your cash on cash return is above the historical rate of return for the stock market, 7%, this is a good use of your money. Take your cash flow and divide it by your initial investment and you'll have your cash on cash return. Therefore, cash on cash return equals before tax cash flow divided by the total cash invested, aka our down payment, closing costs, or any renovations. Again, we want to evaluate some of these metrics on a level playing field with no personal subjectivity to them. So in this example, we're using before tax cash flow because everyone's tax situation is different. On one hand, we want to evaluate real estate as a business objectively, and then on another level, personally. Okay, let's do a quick example. Let's say you pay $20,000 all in, including your down payment, etc., for a house that gives you $2,000 a year in cash flow. You are receiving a 10% cash on cash return. This is called cash on cash because we're only accounting for the rental income. With real estate, there are many other aspects to factor in when calculating total or overall return. All right, return on investment, or ROI. ROI allows for comparison of all types of investments across the board, comparing apples to apples, or say stocks to real estate. Our formula for return on investment is return on investment, or ROI, equals our money invested divided by all realized and unrealized money on an annual basis. Unlike the cash on cash return, return on investment encompasses all the other wealth building qualities of an investment, such as appreciation, equity increase from principal paydown, equity increase from inflation-induced debt destruction, tax benefits, forced appreciation by raising rents through rehab, or just rising market demand. So for contrast, the cash on cash return is the most reliable and face value metric for evaluating returns, but the ROI, or total return, really displays the wealth building effects of your investment. Term number 8, cap rate. A cap rate, or capitalization rate, is best used to compare different real estate investments and most commonly is used in commercial investments. Our cap rate formula is cap rate equals annual NOI, or net operating income, divided by the purchase price of the home or property. Basically, the cap rate is what that ROI would be if we paid all cash for the property. For instance, a $7,000 a year NOI divided by a $100,000 purchase price would give us a 7% cap rate. Term number 9, depreciation. Depreciation is the reduction in the value of an asset over time due to wear and tear. You might be thinking, oh wait, real estate goes up in value, right? You just told us that at the beginning of the video. Yes, real estate is an appreciating asset. However, the IRS, for tax purposes, understands that investments can wear out over time and lose value. So according to the IRS website, depreciation is the recovery of the cost of the property over a number of years. You deduct part of the cost every year until you fully recover its cost. The IRS provision for depreciation is proof that the US tax code was probably written by landlords. Only the improvements such as a building on the land can be depreciated, not the land itself. Using straight line depreciation for residential real estate, we depreciate over 27.5 years. Modifications to the depreciation schedule can include cost segregation studies, which allow us to depreciate certain contents of the improved property on a faster schedule. But we'll have to get into that on another video. To calculate the yearly depreciation, not a depreciation of the price, but for tax purposes, we would take the total value of the improvements of the property, not including the land, and depreciate about 3.6% of the improvement value each year. Then that number will be able to be deducted from your total tax burden for the year, most often entirely offsetting your rental income and allowing you to make tax-free income from your real estate investments. Let's do an example together and make it quick using the rent-to-retirement property analysis tool. Here we are going to use the rent-to-retirement property analysis tool to do some numbers and therefore learn our terms in the process using our little spreadsheet here with a example property called 1234 Main Street. So doing this example, we're just going to work out of this financed column because we're not going to buy our property in cash. Let's assume we're just getting started, so we don't have a ton of money. We're going to finance this property. So let's start out line by line, and not all of these terms are going to be ones that we talked about in the video before because they're pretty self-explanatory, but I will break them down as well as I can so you'll be able to understand. So to start, we are going to look at our market or appraised value. This is what basically the property was listed for when we first saw it, but we actually offered $90,000 instead of a $100,000 asking price, and our purchase price is going to be $90,000. This is going to give us an initial equity of $10,000. So that's just $100,000 minus $90,000 equals $10,000 initial equity. Pretty cool stuff. So our down payment next is going to be 20%. It's pretty standard in buying in a single family investment property. Our amount financed is going to be $72,000, right? That's just, what is that? 80% of our purchase price. So, 80% of $90,000 is $72,000. Next, our down payment amount is $18,000, which is 20%. You can see these two numbers would just add up to $90,000. So there we are. We made up for the rest that we're not going to finance. Next, our closing costs and fees is $2,500. I mentioned this was going to be about $3,000 in our video before, so we can go and change that to $3,000. Our total cash investment, right? Our total cash to close, that was our first term, going to be $21,000. That's going to be our down payment plus our closing costs and fees. Next, our interest rate is going to be a 30-year fixed mortgage at 4% interest. Our debt service, aka our principal and interest per month, is going to be $344. And our debt service, principal and interest yearly, that's just $344 times 12, right, is going to be $4,125. Next, our monthly rent, we're going to rent out the single family house for $850 a month. Our annual property tax is going to be $990 per month. Oh, I'm sorry. Our annual property tax is going to be $990 per year. Our annual property tax is going to be $990 per year. And our annual utilities are going to be zero because our tenant is going to pay that. And our annual landscaping, we're also going to say zero for now because our tenant was going to do that too. Or, you know, we can budget that. I don't know, let's say 500 if you want to do that. That's fine. It all depends on your situation with your tenant. And our annual insurance premium here is going to be $540. Our vacancy rate, or our percentage of gross scheduled income, that was also up here, our monthly rent. That's our gross scheduled income, what we expect to have in rent. So our vacancy rate, which is a percentage of that gross scheduled income or monthly rent, we're going to assume a 4% vacancy rate. So 4% of the time that our property is available to be rented, it's not going to be rented. But the other 96% of the time, it will be. Our maintenance rate, which is also a percentage of that monthly rent, is going to be 4% because we want to be budgeting for maintenance and repairs and things that can go wrong. And our property management rate, which is a percent of gross scheduled income or monthly rent as well, is going to be 10%. Our property managers, they're going to need a cut for the services that they provide. And so, yeah, we have to work that into this model as well. Our gross scheduled income, GSI, after all this for the year, is going to come out to be $10,200. So let's look at the formula for that. We have 850 times 12, okay? And then we have the less vacancy amount, which basically just means minus the vacancy. As you can see, we're going to get that by multiplying the gross scheduled income times 4%. We give us $408, so this parenthesis just means we're going to subtract that out. So our gross operating income, or GOI, right, $9,792 per year. Now we go down here into our annual operating expenses. So property management, again, we're just using that calculation, our gross operating income times our property management rate, which is 10%, $979. Our annual property taxes, we're kind of doing the just a transfer of that number down here. So we're gonna have to pay $990 per year for annual property taxes. Annual utilities, right? Our tenant's paying utilities, so zero. Our annual landscaping, we put in 500. Maybe this could be zero if your tenant's gonna do the landscaping. Annual insurance premium, 540. That's just a carry down. And repairs and maintenance, $392 a year. So our total operating expenses here are going to be $3,401. That's going to give us a net operating income of $6,391, and we can see that. And this is right, this is right from our video before. We had gross operating income plus our total operating expenses, and it's a plus because this is this is a negative number here. So it's our gross operating income minus our total operating expenses. And just for Excel, we have that as a plus. And then less debt service here, we're gonna again, this just means minus debt service, so or negative, right? So we're going to subtract that out, and it's going to give us our cash flow, which we're going to see is going to be $2,266 per year. Now, all this to be said, our cash on cash return, or ROI, from our rental income just for 1 year is going to be 10.79%. And the way we see that is we take our total cash invested and divide our cash flow into it, right? Our cash flow divided by our total cash invested. And 10.79%, dang, that's pretty good compared to the stock market. That's usually doing 7%. So boom, just in year one, and our rental income only return, we're gonna get 10.79%. Very, very good. Very good return. Next, we're gonna look at our cash on cash ROI with depreciation added up on year one. So again, we know about depreciation, 27.5 years. Boom, boom, boom. A little bit more of a, and this is actually using just 27. So we're taking right here our purchase price or our value of the property, which is C2. That's going to be $100,000 divided by 27. And we can even put 27.5 in there. That's going to be more accurate for us. All this to be said, our cash on cash return on investment from rental income only in our first year is 10.79%. And this is really pretty good. We're already beating the stock market's average annual return of 7% just on our rental income. Now, if we add in depreciation, in addition to this rental income, those two benefits together are going to give us 16.08%. Again, this is more than double what the stock market is going to do. So we're cruising, right? Now we're going to have our cash on cash return with appreciation added in to year one. Boom, 35.13%. We're absolutely smoking the stock market at this point. And finally, we're going to look at cash on cash return with our tenant paying down our loan in year one. So all this to be said, a complicated formula here, so I don't want to go too deep into it, but we can reference these cells in our calculator. I will link this sheet to you so you can mess around with it in the description. And 40.96% return in year one. Wow, what a good investment. And it's important to note here, our return on investment for additional tax deductions is not calculated as it varies for each individual, right? We mentioned real estate it can be evaluated from a business perspective objectively, but it can also be evaluated from a personal perspective. And so everyone's tax deductions, etc., can be different, and tax burdens can be different. So we're not calculating that, but we can get even more icing on the cake if we were to calculate that. So over the course of a 10-year time horizon, our total cash on cash return for this investment, this property, is going to be 443.51%. Dang, amazing, amazing, amazing. You can break down this formula if you would like. And here, just for perspective, let us go and compare it to what our total cash on cash return would be on a 10-year time horizon if we bought this property in cash versus it being financed. Comes out extremely different. Look at how these numbers are changing. Pretty different, I would say. So we did modify some things in this formula. I acknowledge that if we equalize them here, but they're pretty much the same. So anyway, this rent-to-retirement property analysis tool is very, very cool. Please check it out. It will break down the terms here in the right column and help you, just walk you through it in case any of these were confusing. And again, just further reinforcing your retention for learning these terms, learning how to evaluate properties, finding good deals. Without all of this, it's really hard to buy good investments. So use this yourself. Call me, call anyone on the rent-to-retirement team. We will fill this out for you if it's still confusing. Leave me a comment in the comment section below if you need any help with it, and I'll be happy to give you a call or help you out online. Johnny Isaacson, the US Senator, said, "In the real estate business, you learn more about people, you learn more about community issues, you learn more about life, and you learn more about the impact of government, probably than any other profession that I know of. This is why we must understand real estate and participate in it in some way, shape, or form. The benefits to doing so are limitless." Remember to like, subscribe, and turn on the notification bell below. For more information, please see the contact info at the end of the video. Thank you so much for taking the time to watch, and we'll see you next week.